Hello friends, welcome you all. I am Sundar from Symphonia Wealth. Today I am going to tell you a very simple and a very powerful investment tool which will help all of us. Before getting into the investment product, let me tell you, every time you walk into a hotel, okay, how many of you actually get confused in terms of what item to order and what item to eat? And most of us actually get confused whether to order a South Indian meal or a North Indian meal or what. So this question comes every time you walk into a hotel. The same feeling comes to you when you also look at an investment opportunity. Should you invest in gold? Should you invest in an international fund, or should you look at a domestic fund, etc., etc.? What if something like a mini thali, which gives you a combination of everything, which actually solves our purpose of eating everything and tasting everything? Similarly, in an investing world, can there be a product which can actually help you taste each and every asset, because each and every asset actually performs at different points of time. If gold is performing good, most likely the equity might not perform well. If debt is performing well, maybe the gold might not perform, etc., etc. So similarly, like a mini thali, can you have an investment portfolio which can have combination of everything into it, whereby you can actually participate in every asset class? Yes, there is a product like that which is called as a multi-asset fund, which gives you a opportunity to invest across asset classes, right from domestic equity to international equity to gold, debt, commodity and various other kind of asset classes. Just by investing in this particular fund, you actually have access to all these kind of assets. So why should you actually invest in such a fund which actually gives you opportunity to invest across assets? If you want to buy gold, you can actually buy gold. If you want to buy international fund, you can also buy an international fund. Of course, the answer is right, but at what proportion should you buy? I think that's the biggest question in everyone's mind. And more importantly, when should you buy gold and when should you buy domestic equity? So this is a big question to answer, and most of the times even the best of the fund managers can actually go wrong. So just to avoid this, if you can have an allocation across asset classes, and whenever an asset is likely to perform, if you can actually increase the allocation slightly over it, then your overall returns can be very good. So like the chart which I have shown, if you look at 4 asset classes have been shown. You have domestic equity, you have international equity, you have gold and also debt. If you look at the performance is ranked by way of dark red to green. Green means in that particular year that asset has actually done well. Dark red means in that particular year that asset has given you the worst performance. And if you look at the graph or the chart, which clearly tells you there is no one asset classes which is neither always on the top or always on the bottom. In fact, it keeps skipping from one place to another. So as an investor, it is very difficult for you to identify which asset will do well and which asset to be avoided in that particular year. A multi-asset actually gives you that flavor of having everything in a single bouquet, whereby just by doing the asset allocation proper, your returns over a period of time can be actually good. It does not mean that you will get the highest return, but naturally this product actually helps you de-risk yourself from a particular asset class, because you can't put all eggs in one basket. So this asset over a period of time actually gives you a very good risk adjusted return. So the next chart is actually over a 23-year period. We have plotted the performance of each asset, and we have also plotted the performance of a multi-asset. So if you look at domestic equity actually scores the highest, which actually from a return point of view is actually delivered close to about 13% compounding return. The second best is a multi-asset category, which means you have got everything in the basket, which comes almost closer to equity fund, which is close to about 12.2%. Of course, the difference is not very huge, but look at the second column which tells you about the standard deviation, which is the which tells you the amount of risk each asset has actually taken. The domestic equity standard deviation is 22%, whereas the multi-asset has actually taken a standard deviation of only about 12%, which means for a very low risk, your return is almost equal or just a 1% lesser than the domestic equity, which means If somebody wants a lower volatile kind of an asset and you have a slightly longish kind of a time frame, I think multi-asset can actually help you sail through this volatility and also attain a reasonably a good double-digit kind of a return. So who should be looking at investing in these kind of products? Ideally for somebody who is not sure where the market will go or which asset to look at. He or she could be a retail investor who is just entering the investing world for the first time. So the best thing is to actually pick up a mini thali kind of a product which actually helps him not really think too much about it, just keep investing. Over a period of time he actually gets a very good risk adjusted return. Or somebody who is a very seasoned investor who wants to actually do asset allocation, but doing asset allocation is a very difficult job because it also, you need to actually keep readjusting your portfolio, you need to keep rebalancing the portfolio, there are costs associated with it. But by even a seasoned investor can actually allocate some part of the money into a multi-asset fund which actually takes care of it. And somebody who is a retired investor or a retired person who also wants to look at investing, but he wants his volatility to be low but a return which is slightly better than a debt product or a FD product, which also actually suits very well for a person who is retired. Which means this is like a all-weather kind of a fund where anyone can invest, and if somebody has a 8 to 10 year kind of a time frame, I think he can actually earn a very good risk-adjusted return. So what are the benefits of investing in this product? As I told you, diversification. I think in a single product you can actually invest in across assets. So that's a big diversification. Second, more importantly, not all assets perform at the same time. So naturally you need to be present in all assets so that whatever performs, your portfolio keeps growing. Then the cost involved in terms of the taxation or in terms of the entry and exit is actually almost become zero, because since you are within a fund, whatever exits the fund manager does, say assuming he moves out of gold and invests that money in domestic equity, there is no tax involved because at a fund level there is no tax. Whereas if an individual wants to do that, there is tax associated to it, there is entry and exit, meaning the timing becomes a very important factor, and other things also are very vital. More importantly, it is very easy and hassle free, and there is no need to time the market because you don't know what time to enter, because the fund manager has a fixed kind of a template whereby he actually adjusts the allocation of each particular asset based on the view of the asset class. And another very interesting thing is it is very low volatile kind of a movement. Of course, it also can erode your capital in the short run, but in the long run the volatility is very, very low. So if somebody has a 10-year kind of a time frame, the smoothness of the investment is much more better. As I explained, the standard deviation of these products are much lower compared to a equity fund. Also, out of the various products which are available under the multi-asset category, some funds also actually enjoy the indexation benefit, because if the overall domestic equity is up to 35%, those funds actually enjoy the indexation benefit, which actually is a added advantage, because at a tax adjusted return, these indexation based funds actually help you garner a 0.5% to 1% more on the compounding. So simply put, this is a very good product where your returns can be in double digit and the risk is relatively low, provided you have a 10-year kind of a time frame. So this actually can be a very good entry product where you don't need to really worry about where the markets are headed and which asset will do well, etc., etc. So as part of the allocation, I think this is one category of product which can be considered in every individual's portfolio. Hope you enjoyed the information provided. Thank you for watching.